Welcome, everyone, to The Deep Dive. We're here to cut through the noise, get straight to the insights you need.
That's right.
Today, we are diving headfirst into Lakeland Fire and Safety. Ticker, Lake. Their Q2 fiscal 26 results just dropped after the bell yesterday. And, well, on the surface, some really strong headlines.
Definitely some eye-catching numbers.
But the market reaction immediately after, it suggests there are maybe some deeper questions. Things to unpack.
Absolutely. Lakeland presented this quarter with record revenue, which is great, and significant sequential margin recovery too.
Right.
But, and it's a big but, they also updated their full year guidance, and that seems to have, let's say, tempered some of the initial excitement.
Okay.
So our mission today is to peel back those layers. We'll look at the core numbers, management's strategic moves, their chess game, really, and critically, what does all this signal for the broader safety and industrial sectors? We need to go beyond just the headlines here.
Give you that context, that understanding. All right, let's get right into it then. Headline numbers for Q2 FY26. What's the quick read? The top level.
Okay, quick read. Lakeland reported GAAP EPS of $0.08. Now, that's a really significant turnaround when you think about it.
Compared to last year.
Yeah, compared to a loss of $0.19 in the same quarter last year. So big swing.
Okay, that's positive.
And revenue hit a record, $52.5 million. That's a robust 36% increase year over year.
36%.
Wow.
But I thought I saw something about estimate.
You did. And here's where it gets a bit nuanced. That $52.5 million, while a record, actually came in slightly below the consensus estimate.
Ah, okay.
Which was around $55.7 million. So a record number, yes, but not quite hitting what Wall Street hoped for.
So a top line miss, technically, but a solid bottom line beat with that EPS turnaround. That's an interesting mix right away.
It is.
Does that maybe suggest management is, focusing more on profit and efficiency? Maybe even letting some top line growth slide to achieve it? Or is there more going on?
That's exactly the tension. The market seems to be grappling with that. If we dig into the profitability side, adjusted EBITDA, and this excludes foreign exchange impact, came in strong at $5.1 million. And that's not just good, it's an impressive 89% increase year over year.
89% increase.
Yeah, translates to a pretty healthy 9.6% margin.
Yeah.
But what's maybe even more striking is the sequential improvement.
From Q1.
From Q1 fiscal 26, yeah. A massive 740% jump.
740%. Goodness.
It's huge. Now, gross margin, always a critical one, landed at 35.9%. That showed a 240 basis point sequential improvement. So 2.4 percentage points better than Q1.
Okay, moving in the right direction quarter over quarter.
Definitely. But still down 370 basis points compared to the same quarter last year.
Ah, there's the other side of it.
Exactly. So while the underlying operations showed strong recovery, efficiency gains, that year-over-year dip in gross margin, plus the slightly tempered outlook, it clearly gave investors some pause.
Okay, that gives us a snapshot. And yeah, already seen some interesting dynamics. So here's where it gets really interesting, right?
Yeah.
Let's dig into these financials, the management insights. What exactly was driving that big 36% revenue growth? Any specific segments really pulling the weight?
Oh, absolutely. The primary engine, without a doubt, was their fire services segment.
Okay.
Sales there just surged an incredible 113% year over year, hit $25.6 million.
Wow, 113%.
Yeah, and now it makes up almost half, 49% of their total revenue.
So a big shift in the mix.
A huge shift, and it really reflects, I think, increased government, municipal spending, post-pandemic on essential services. Lakeland seems really well positioned there.
Right, with their products and regional strength.
Exactly. So the takeaway is fire services isn't just a growth engine. It's becoming the foundational pillar for Lakeland's revenue. Makes them less reliant on maybe other more volatile segments.
Makes sense. What about regionally?
Regionally, the U.S. market was a standout.
Oh,
Sales climbed 78% to $22.1 million.
78% in the U.S. Strong.
Very strong. And Europe was equally impressive, up 113% to $15.1 million.
Okay.
What's really fascinating, though, is even with acquisitions playing a role, which they did, organic sales growth still contributed a very healthy 14% year over year. So the core business underneath it all has real momentum.
Okay, 14% organic is definitely solid. So incredible growth in fire, key regions powering ahead, points to real demand for their gear. But help me square this. If revenue's soaring like that and we are seeing that sequential margin recovery,
Yeah.
Why the year-over-year decline in gross margin still? What's holding that back?
Yeah, that's the million-dollar question, isn't it? So the adjusted gross margin, while it improved sequentially, like we said, to 37.4%,
From Q1.
it was still down quite a bit from the 41.1% they had in the prior year. Management pointed to a few key things.
Okay, what were they?
Primarily lower gross margins coming from companies they recently acquired. That's pretty typical, sometimes takes time to integrate and optimize.
Sure, integration drag.
Exactly. Then increased material costs. Just across the board, inflation is still a factor. And specifically, this persistent headwind from tariffs.
Tariffs again. How much impact?
They said tariffs alone impacted margins by about 1.2 percentage points in the quarter.
1.2% just from tariffs. That's significant.
It really is. But there's some good news. They indicated that price increases they put through earlier are finally starting to catch up, starting to gain traction in the market.
Okay, so relief might be on the way there.
They seem pretty optimistic about it. They anticipate further sequential growth, both in gross margin and adjusted EBITDA in Q3.
Right.
But it does raise that important question for us and for you listeners. Can they keep up the sequential recovery pace? Can they fully offset these external pressures going forward?
Yeah, sustainability is key. Operational efficiency seems like a major theme then to counter those pressures. But, how much more fat can they really trim? Is there a risk of cutting into bone, or is this genuinely untapped potential they're finding?
That's a fair question. Management seems pretty confident they're targeting true inefficiencies, not just cutting costs blindly. And they've been really active.
Like what? What moves have they made?
Well, they completed a $6.1 million sale-leaseback of their Decatur, Alabama property.
Okay, sold the building, leasing it back.
Exactly. And importantly, 100% of those proceeds went straight to paying down their revolving credit facility.
Strengthening the balance sheet. Good move.
Directly reduces debt, gives them more flexibility. Yeah. They're also streamlining their global footprint, closing a warehouse over in Hull in the UK.
Okay.
And consolidating manufacturing from their Veridian facility down in Quitman, Arkansas.
So real consolidation efforts. What's the expected saving?
These aren't small tweaks.
Yep.
They expect these moves to generate about $4 million in annual OPEX reductions.
$4 million annually.
Yeah, and they're targeting another $3 million specifically for the second half of this fiscal year, FY26.
Okay, ambitious. Are they seeing results yet?
They are. They said $1 million in savings already materialize in Q2. So they're not just talking the talk. They seem to be walking the walk on efficiency.
All right, so clearly tightening the belt, getting leaner, that's the defense. But you can't just cut your way to long-term success, right? Let's pivot to offense. What about new products, market opportunities? What's exciting management there?
Exactly. Innovation is crucial. On the product side, they mentioned their Pacific traditional fire helmet. It has this Halo Flex suspension system.
Halo Flex.
Yeah, apparently it's gaining significant traction in the U.S. market. Comfort and fit are huge for firefighters wearing gear for hours. It sounds like the suspension really delivers on that.
Little innovations can make a big difference in that field.
Absolutely builds loyalty. Beyond helmets, they secured a big Italian boot order, $3.1 million from Jolly Scarpe.
Jolly Scarpe.
And an even bigger potential catalyst coming up. They expect to launch an NFPA-certified Jolly boot.
NFPA, the big standard in the U.S.
Exactly, the gold standard for safety gear. They plan to launch that into the U.S. market in the first half of fiscal 26.
And the U.S. market for turnout gear is?
It's the world's largest. So huge opportunity there if it hits well.
Definitely one to watch. Anything else on the horizon?
Yeah, management also highlighted that fire services tenders, those big competitive contract bids from cities, counties.
Right, the lumpy but large contracts.
Exactly. They expect those to restart both in the U.S. and EMEA late in fiscal 26 or maybe early fiscal 27. That could provide a really significant boost to the pipeline and the top line down the road.
Okay, good pipeline potential. Now, you also mentioned management talked about M&A. An active pipeline, maybe a new area. What's going on there?
Yes, and this feels like a really significant strategic pivot for them. It speaks volumes about their long-term vision.
Okay.
They're aggressively pursuing M&A opportunities, specifically within the fire suit, rental, decontamination, and related services business, mostly focused on the United States right now.
Rental and services. That's different from just selling gear.
Very different. It's a deliberate move towards building a more predictable, recurring revenue stream.
Right. Less lumpy than waiting for big tender wins.
Precisely. Moving beyond just selling the gear itself, management described the pipeline here as robust, even used the word imminent.
Imminent, so deals could be close.
It seems like it. They expect 1 or 2 smaller deals maybe to close in the coming months. The goal is to build out a network covering most of the U.S.
Interesting.
If you connect the dots, this strategy could really diversify their revenue mix, make them less susceptible to the cycles of gear purchasing, and potentially stabilize earnings over time. It feels like a smart play for long-term consistency.
Okay, so a lot of positive strategic moves, operational efficiency, organic growth drivers, this new M&A focus on services. But despite all that, the guidance was tempered. What were the specific headwinds that forced them to adjust that full-year outlook?
Yeah, the headwinds were pretty significant, unfortunately. First, that ongoing tariff uncertainty. It just continues to cast a shadow, makes it really hard to predict costs and pricing accurately. Still a problem.
Still a problem. Second, they saw significant softness in Latin America. Sales there decreased by a hefty 42%.
42%? Wow. Why?
Or about $3.6 million down, largely due to delayed purchase decisions from customers down there. Sounds like maybe economic or political uncertainty is causing buyers to just pause.
Okay, LATAM weakness, big drag.
Huge drag. Now, management does expect a substantial recovery in LATAM in the second half of the fiscal year.
Okay, some recovery expected.
But they were frank, they admitted it won't be enough to fully offset the decline they've already seen year to date.
Got it. So those two things combined.
Those two factors, tariffs and LATAM, led them to update the full year guidance. They now expect revenue to land near the low end of their previous range.
Which was $210 to $220 million?
That's right. So expect it closer to $210 million now. And adjusted EBITDA, excluding FX, is now projected between $20 million and $24 million.
Okay. But importantly, this revised guidance implies they expect higher EBITDA in the back half of the year. They're really counting on those operational efficiencies and cost cuts we talked about to drive that.
So banking on execution in H2, it sounds like they're navigating some pretty choppy waters, but they do seem to have a plan.
Looking beyond just this fiscal year, what's the longer-term vision? Are they hunkering down or still aiming high?
Oh, they are definitely not just hunkering down. Management sounded quite confident, actually, about their long-term outlook. They're projecting accelerated growth over the next, say, 3 to 4 years.
Just accelerated growth. Okay.
And their vision includes EBITDA margins expanding significantly into the mid to high teens over the next 3 to 5 years.
Mid to high teens. So that would be a huge leap from the current 9.6%.
A massive leap. They believe it'll be driven by continued cost discipline, that strategic acquisition strategy focusing on recurring revenue, and just ongoing operational enhancements.
Makes sense. Anything else key to that vision? Yeah, they also really highlighted inventory optimization. This is important. Current inventory levels are around $90.2 million.
Which they said is too high.
Yeah, they explicitly said it's too high. They aim to bring that down into the $80 million range.
Okay, why is that so important? Just tidying up?
No, it's much more than that. It's crucial for working capital optimization. Bringing inventory down by $10 million or more frees up tens of millions of dollars that were just tied up in goods sitting in warehouses.
Turns inventory into cash.
Exactly. Cash they can then use for investments, debt paydown, or just strengthening the balance sheet. It's a direct route to improving cash flow and financial flexibility, which is absolutely critical for funding those long-term growth goals and M&A plans.
Right, unlocks capital. Okay, so let's bring this together for the listener. If you, the investor, are looking at Lakeland right now, it's definitely a mixed picture, isn't it?
Yeah.
Record revenue, sequential improvements are strong points.
That's absolutely positive signals.
But that tempered guidance, the market reaction, clearly some skepticism remains. How should you be thinking about this?
Precisely. While the record top line and the EPS beat are good news, the market seems heavily focused on that revised revenue guidance, right?
Yeah.
And the ongoing risks tariffs, the LATAM softness, those weigh on the near-term story.
And the inventory.
And the high inventory levels, too. Even though management has committed to reducing them until those numbers actually come down, it could remain a point of concern about working capital efficiency. It really is this push and pull between strong operational execution on one side and these macroeconomic and regional headwinds on the other.
Okay, given that push and pull, that complexity, what should investors be watching for, specifically in the coming quarters? What are the key indicators that will show which way this story is heading?
Yeah, key watch items. In my view, there are several critical things. First, the sustained cadence of that sequential margin improvement. Can they keep improving gross margins? Can they keep growing adjusted EBITDA quarter over quarter? That's number one.
Consistency on margins. Got it.
Second, we need to see proof of that recovery in Latin America. Was it just a temporary blip or is it a deeper issue? The order flow needs to visibly pick up.
Okay, watch LATAM orders.
Third, and this is really important, the timing and the success of those new fire tender wins in the U.S. and EMEA. These are big contracts that can really move the needle on revenue.
Tender wins.
Right.
Anything else?
Beyond that, flawless execution. They need to deliver on those targeted cost savings, the warehouse closures, the consolidations, and they absolutely have to hit that inventory normalization goal. Getting inventory down is key.
Execution is everything.
It really is. Any upside, any positive surprises in these areas could really help close that gap between the top-line momentum they say they have and the profitability the market seems to be questioning right now. It's a classic story. Can strong operational levers overcome macro headwinds?
Fascinating dynamic. Okay, now for our favorite segment. This is not financial advice. We put on our imaginary hedge fund analyst hats, pitch an outrageous but plausible trade idea. Lakeland dipped a bit after this mixed report, but has these longer-term strategic moves.
Yeah.
Well, what's your play?
All right, my pitch. Given that initial market reaction, the slight pullback, it's got to be a contrarian play, but layered strategically. A long position.
Going long after they trimmed guidance. That's the outrageous part.
That's the outrageous part. Buying into a stock that just took a little hit after hours. But the plausible thesis, the core idea, is to maybe initiate a small, long position right here. Perhaps even ladder in if there's any further weakness from short-term noise.
Okay, scaling in. Risk management.
Definitely. Set a tight stop loss just below that recent intraday low. Maybe around 13.90 cents, just to manage the immediate downside risk. But the real play, the one that gets interesting, is a longer-term call option strategy, targeting maybe year-end.
Call options. Okay, bold. What's the conviction? What's the catalyst you're betting on?
The core belief driving this is that the market is currently over-discounting these near-term headwinds. The tariffs, the LATAM slump, and significantly underappreciating two key operational levers that could unlock value much faster than people think.
Okay, lever number one.
Lever number one, management's stated urgency, their concrete plans to hammer down that $90 million inventory level to the $80 million range. Remember, this isn't just housekeeping.
Right. Working capital optimization.
It frees up tens of millions in cash that could dramatically improve the balance sheet, boost free cash flow metrics. Imagine the positive sentiment shift when they announce they've hit that $80 million target. That's a tangible win.
Okay, inventory reduction as a catalyst, lever number two.
Lever number two, that imminent M&A pipeline, specifically in the fire suit rental and decontamination services business.
Recurring revenue play.
Exactly. These might be smaller deals initially, but they're high margin, sticky, recurring revenue plays. This could fundamentally shift the perception of Lakeland's revenue quality, provide a much clearer, more predictable path towards those mid to high teens EBITDA margins they're aiming for long term.
So the combo could be powerful.
The combination, yeah. Aggressive, visible inventory reduction showing financial discipline, plus a successful M&A announcement demonstrating strategic progress towards recurring revenue. That's the potential 1-2 punch. That could be the spark that really ignites the stock.
And your target if this plays out.
If they execute successfully on these 2 points, inventory and M&A, by year end, I think a target price in the $18-20 range becomes plausible. It's really a bet on operational execution and smart acquisitions trumping temporary macro noise.
An interesting catalyst-driven thesis. Okay, so wrapping up this deep dive into Lakeland Fire and Safety's Q2, what have we really learned here? It's complex, but there are clear themes.
Yeah, I think Lakeland showed a quarter of really strong top-line growth, especially fueled by that fire services segment, and they demonstrated significant sequential improvement in profitability thanks to those operational efficiency efforts. But the ongoing tariff uncertainty, the unexpected weakness in Latin America, and that revised full-year guidance, it definitely led to a cautious, maybe skeptical market reaction.
Yet they're not sitting idle.
Not at all. The company is actively executing on cost cuts. They're critically focused on optimizing that inventory for better cash flow, and they're pursuing that really interesting M&A pipeline targeting recurring revenue. They have levers they are pulling.
So what's truly fascinating here is you have this company with strong underlying organic growth in key areas, a clear strategic vision evolving towards services, concrete operational plans, but they're doing it all while navigating a pretty challenging external storm, playing offense and defense simultaneously.
Indeed. And while the path ahead clearly has hurdles, those external pressures are real. Management's proactive measures, their commitment to financial discipline, that long-term vision for significant margin expansion, it absolutely makes Lakeland Fire and Safety a story worth watching very closely.
The question isn't just if they hit their goals, but maybe how quickly their operational wins can start to really outweigh those macro headwinds in the numbers.
That's the key tension to monitor.
Absolutely. And as always, remember, folks, this discussion is purely for informational purposes. It should definitely not be considered financial advice.
Please do your own research.
We really encourage you to do your own homework, consult with a qualified financial professional before making any investment decisions. But we'd love to know, what stands out to you from Lakeland's call? How are you weighing their operational strengths against those macro pressures? Drop us a line. We love hearing your insights. Until next time, stay informed.